Okay, we are live. Welcome to Boston Basic Income. I'm Alex Howlett.
I'm Derek Van Gorder.
This week we are discussing Chapter 3 of Stephanie Kelton's The Deficit Myth. And the title of the chapter is The National Debt That Isn't, in parentheses. So the idea with this chapter that she's trying to hit home is the answer to the question of whether something bad is going to happen to us later because the government borrowed today is no. And maybe it doesn't even make sense to think of the national debt as a form of borrowing. So that's why she says the national debt that isn't. So what is the national debt? What do we mean when we talk about the national debt? And that's the question that she's asking and answering in this chapter. And she's saying that the national debt isn't what you think it is. And it's not something that we have to be worried about at all, especially in a place like the United States, where the country is the issuer of its own currency. So I want to get into the first quote from the book here. Myth: one way or another, we're all on the hook. Reality: the national debt poses no financial burden one way or another. So the national debt is our country's money. I like to say that the national debt is our country's money. So that includes the treasury bills that have been issued and the money that has been issued, or the base money that has been issued by the Federal Reserve. In chapter 1, Stephanie Kelton makes a great analogy where she says there's these two kinds of money that the government issues. There's green money and yellow money. So green money is the economy's base money, and then yellow money are the treasuries that are issued by the Treasury in order to borrow, right? And the thing that's different, or the most important thing that's different between the treasuries and the base money, is that the treasuries pay interest. So the yellow money is just a form of money that pays interest. And then it's up to the Fed, the central bank, to swap green money for yellow money. Importantly, in this chapter, when she talks about the national debt, she's referring to the yellow money as debt and the green money as not debt. So she might say, oh, well, it's possible to retire the entire national debt by having the Fed buy up all of the yellow money, all of the treasuries, and then leaving you with just green money. So you've monetized the entire national debt. And then if you're not thinking of the base money as a form of debt, the national debt is gone. I think it's more accurate to say, yes, these are both two kinds of money, but they're also just two ways of expressing government debt. In particular, the base money is an IOU for goods. It's a promise that you can redeem your dollars for goods in the economy, and then the treasury securities, the treasuries, are IOUs for base money. So they're one step below in the hierarchy. If you're consolidating the government's balance sheet, which MMT likes to do, they like to consider the treasury and the Fed as one entity called the government, then that hierarchy gets abstracted away from. You're not paying attention to the fact that one form of government money is an IOU for another form of government money. So that's kind of the preferred lens of MMT. And that helps simplify things a little bit, especially in the sense that if you're thinking about what ultimately constrains government spending, then that's going to be, well, how much stuff is there to buy in the economy? You can't buy more than there is to buy, essentially. So that always is going to be the ultimate constraint. If you separate the Fed and the Treasury and you have the Fed in charge of maintaining a stable price level, then what it starts to look like is the Fed has to set monetary policy in such a way that you have stable prices. So the Fed is constrained in what they can do. They're constrained in how much of the yellow money they can replace with green money in the economy. So they can't just buy up all of the yellow money, because if they did, then that would be potentially inconsistent with price stability. So if the Fed is constrained in this way, then that in turn constrains the Treasury and what they can do. And that limits the amount of borrowing that they can do, the amount of yellow money, the amount of treasuries that they can issue onto the market.
Yeah, so there's different ways of phrasing this. This observation has different implications. So Kelton says that the national debt is not a financial burden. She says the government faces a resource burden, but not a financial burden. In your view of this different view of the national debt, Is that accurate, inaccurate to say? What does Kelton mean by financial burden? And how is that different from like an economic burden or a resource constraint in general?
Yeah, so she's basically saying that there's no nominal constraint since the government issues the money that they can issue as much of it as they want. But there are real constraints, and I like to think of real constraints as a kind of financial constraint. So that's how I kind of reconcile the two views. If the money that you issue is an IOU for goods, then you have to be able to force a flow of goods towards the holders of money so they can claim the goods with their money. And if you can't do that, that looks a lot like a financial constraint. It's exactly like, if you're a bank and you have deposits, those are IOUs for base money, right? So you have to be able to force a flow of base money towards your deposit holders when they come to withdraw their money, right? So it's a very similar arrangement. So it is a kind of financial burden. And the financial burden becomes more explicit when you separate the Treasury and the Fed, because if the Fed is over on its own saying, okay, we have to keep interest rates at a certain level, and that means we're going to buy a certain amount of government debt, then they're constrained in how many treasuries they can buy, and that in turn means that the government is constrained in how many treasuries they can issue, or how much money they can raise by issuing treasuries, right? Because if the yield on treasuries is 80% or something like that, then for every $100 of treasuries that you issue, you're only raising $20. For every $100 of yellow money that you issue, you're only getting $20 of green money if you're the Treasury. So it gets to the point where the interest rate can be so high that it's unsustainable. So Stephanie Kelton likes to argue that, well, the government can just choose the interest rate, whatever it is, but really the interest rate is constrained by price stability. And the Fed can't just buy up all of the government bonds to keep the interest rate low if they want to be consistent with their price stability mandate.
Yeah, but Kelton she wants to be able to make the claim that the government is different from you or me or the private financial sector. They're issuing this money. The rest of us are not, or we can't. And so this language, I think, kind of goes along with that. But in your view, you're saying that needing to have money to pay someone money that you owe isn't actually that different from needing to have goods to make sure that the money can be exchanged for them if you're the government, right? It's on a slightly different level. So it looks different, but it's not as different as Kelton is saying.
Yeah, I think it's not as different as Kelton is saying. And part of the way you can see how that is that the government is not borrowing in dollars. They're borrowing in goods, and the debt is denominated in dollars. So they have to make good on that promise for goods. If you're borrowing from the bank, you're borrowing in dollars. And if the bank is actually, to put it the other way, the bank, when you have deposits in the bank, they're borrowing dollars from you, and they have to make good on that promise for dollars. And it's the same thing with the government. They have to make good on that promise for goods. So you're never borrowing in your own currency. The debt might be denominated in your own currency, but it's ultimately an IOU for goods at the highest level. The base money is an IOU for goods. And then that gets obscured a little bit by the fact that treasuries are really just an IOU for the base money, which is an IOU for goods. So it looks like you're borrowing in your own money, which you are if you're the treasury. But if you're going to do this trick that MMT likes to do, which is to consolidate the balance sheets of the Treasury and the central bank, then it's no longer the case that you're borrowing in your own money. You're borrowing in goods at that point. So they have these two views. One is the consolidated balance sheet, and then you can kind of look at it all as one thing, and then it looks like they're just issuing money, and it's an IOU nothing or an IOU for itself or something like that. But if you're gonna consolidate the balance sheets, you have to go all the way, and you have to realize that the base money is not an IOU for itself. It's an IOU for goods.
Later in the chapter, she talks about how, if we're going to pursue this more expansionary fiscal policy, we sort of have two options vis-a-vis the debt. I mean, one option is that we can erase the debt, like she says, and the central bank can type in the numbers in the computer and buy up all the bonds, and then we don't have, and then find some other way to do monetary policy using the other tools they have. And then the second option, she says, which is sort of equivalent, is that we just become at peace with this language of the debt. Maybe we call it something different. But what you're saying, I think it lends itself easier towards the latter. Like once we get okay with the fact that money is a form of debt, and there's different types of money, and there's different types of debt, and it's all really the same thing we're talking about, just different varieties of it that serve different purposes, then it doesn't matter so much. And the debt can just be like Kelton says in the book, it's kind of a historical record, and we just don't have to worry about it as much anymore.
Yeah, I think that's right. The debt, in terms of the just accumulation of deficits over time, the national debt that you see on the debt clock is this historical record of how many dollars the government has spent into the economy in excess of taxation. And I like to use the term budget debt to describe that. And then I can use the term market debt to describe the volume of treasuries that's out on the market. But if we're going to be completely honest, the market debt isn't just the amount of treasuries. The market debt is also the base money. So then what's important about the market debt is the mix of it, the balance between, non-interest bearing dollars and interest bearing dollars, and how that affects monetary policy. Now, in terms of the government getting to the limits of what it can do, its real resource limits, when you're at that point, they can either use fiscal policy to pull back from the limits, to activate fewer resources so they can act somewhere, so they can activate more resources somewhere else, or they can choose to default on the debt, or they can choose to have inflation, which is like a partial default. But you're still up against this real resource constraint, and you have to kind of do one of those three things when you get to the limit.
That's different. I mean, just to go off of Bethany's question in the chat, that's different from Kelton's view, which is that, well, yeah, no, the resource constraint is there, but she's emphasizing that you're sort of blending that together with the financial constraint, with the constraint that the government's use of money and the ability to spend money, the relationship that has to the resource constraint. Whereas I think Kelton has rhetorically likes to really sharply separate them and say, no, the government does not have any kind of, it doesn't need the money, and this is just something it doesn't have to do. It could spend and cause inflation, but it chooses not to. So, I mean, I guess to play devil's advocate, I mean, we're all, you and Kelton are starting in this world where politicians and budget makers are very much kind of, at least to hear Stephanie Kelton describe it, and from her work with working with these kind of people, they're stuck in a lens where, you're borrowing first to collect dollars that you then pay out right into the economy. And we have to raise taxes to balance the budget and all that stuff. And so she's really trying to wage war on that viewpoint, that idea. And she's drawing this line and saying, no, forget it. The government issues the currency. So it's not, there is no financial constraint there. I mean, I guess, why do you have an issue with that? I mean, given the reality that we're living in today.
Well, it's because the constraint is there. It's just we're looking for it in the wrong place. We're looking for it as, the tax revenue has to balance against government spending. And if you're running a deficit, then that's a problem. But really, your money is not, it's an IOU for goods. So the question is whether you can come up with the goods, whether when people spend their dollars, they can get the stuff with the dollars. So that puts the constraint in a different place. You can't just look at, whether the budget is balanced in order to know that you're up against that constraint. So I think Kelton would agree with that. She's a little bit looser about inflation than I am. I feel like inflation is analogous to something like a default. So she kind of has that as a separate thing. Like, once you understand that taxes don't exactly have to match spending, then you can look at what the constraints actually are. And if you spend too much, there might be inflation, that kind of thing. I would say that constraint is the constraint that people are looking for. They're just looking in the wrong place.
Makes sense. We've gone over this in the other episodes, but it's useful for people who might not have watched those.
Yeah. So let's get on to the next quote here. They all had a love-hate relationship with the national debt. They loved U.S. treasuries as long as they thought of them as financial assets held by the private sector, but they hated the very same securities when they considered them obligations of the federal government. Unfortunately, you can't wave away the national debt without also eliminating the instrument that composes the national debt, U.S. treasuries. They are one in the same. I'm sure she means one and the same. So I would say yes. I would also say that the base money falls into this category too. You can't wave away the national debt without waving away the currency, the base money in the economy. So waving away the national debt isn't just about replacing the treasuries with base money. It's about shrinking all of this stuff. And I think sometimes, depending on rhetorically what point she wants to make, sometimes she includes the base money in the national debt, and sometimes she doesn't.
Yeah, I want to emphasize that on a technical sense. So when we say the national debt, what we're really saying specifically is the total amount of dollars spent over time more than the amount of dollars taxed by the government, right? And then if we divvy that up, we could see that corresponding to government bonds issued on one hand, but then also just, but that's not the case for the entire thing, right? It's not the case that all that entire difference represents, bonds that are held either by the central bank or by somebody in the market.
Right. Or it's bonds that are held, well, yeah, either by the central bank or by somebody in the market. And when they're held by the central bank, then that kind of corresponds to base money in the economy. Now, is it the case that when you're talking about new spending, that's certainly what happens to it. Historically, how did the debt get there? It could be a little more complicated than that, or not quite that simple, in the sense that taxes ultimately are really, what you're doing is you're taxing resources and goods. And then when you're taxing money, what you're doing is you're taxing it, instead of taxing the resources or goods directly, you're taxing a claim on the resources or goods. So historically, you could imagine that stuff was done more in terms of gold, and maybe some of the debt was, I don't know the history or historically where the national debt came from. Going forward, you can say, yes, this is always going to be true, that the national debt corresponds exactly with how many government issued dollars are out there, whether they're green dollars or yellow dollars, base money or treasuries. But historically, maybe not so much.
Gotcha.
Yeah. So yeah, I mean, I think this is an important point. It's important for people to understand this, that the government's debt is our money. So if you want to eliminate the national debt, then that means eliminating the economy's money. And obviously people don't want to do that. So
yeah, in this chapter, I don't think correct me if I'm wrong, but I think she fell short of making that specific point. She's sort of emphasizing that, well, if you erase the government debt, you erase the treasury securities. People like the treasury securities, but you're kind of going a step further and saying, really, we're also just talking about money itself. We're talking about government-based money in the economy.
Yeah, exactly. I think it's tricky because in this chapter, she acknowledges that the debt on the debt clock, the budget debt, is a record of how much money the government has spent in excess of taxation. So that includes not just the treasury securities, but it also includes the base money. So when she's talking about that, she's including everything. But then when she's talking about like retiring the debt, she's talking about converting all of the treasuries into base money.
Yeah, and this can get complicated, but I guess the simple way of reducing it is to just point out that
it's all debt.
It's all debt, right? So there's two different types of money: the treasuries, the government bonds, and then the U.S. dollars are both two different types of money issued by the government, which are also two different types of debt. And then it kind of gets a little simpler.
Yeah. So let's go to the next one. The Congressional Budget Office has just released its 2015 to 2025 budget outlook, and the senators were poring, I'm sure she means pouring without the U, over the report's findings. The CBO had projected that the fiscal deficit would stand at $1.1 trillion and the gross federal debt would reach $27.3 trillion in 2025. So I selected this quote because I just wanted to point out that we surpassed that level in 2020, partly due to the COVID crisis. But it can raise the question. I mean, in this section, she's talking about how big numbers are scary to people. And the question is there any number of government debt that should be scary to people? And my sense is no, that's not what we should be paying attention to.
She talks about meganumophobia, this,
right.
Not exactly a real world, but one that, not a scientific term, but one that describes this fear of large numbers. And it is it sounds a little funny, but is that really sort of the problem that we're getting when you get down to the root of it? Why do people not like the national debt? It's just because, well, the word debt, we have negative associations, and the more zeros you add onto it, it gets scarier, right? If we think that's a scary word, but like there's so many things if you add up in the economy, like the economy is growing. All the numbers are going to get larger over time. So is this just like the economy is so large now that it's kind of beyond most people's ability to sort of be okay with the scale of it, with the size of it?
Yeah, I think a lot of it is this psychological thing, but I think people also know that there's kind of this constraint on how much the government can spend or how much the government can borrow, and they don't want it to be. They don't want to be up against that constraint because that limits what the government can do. So I think Stephanie Kelton likes to draw this hard distinction between monetarily sovereign governments and non-monetarily sovereign governments that don't issue debt in their own dollars. But I think the constraints are largely analogous. It's just that if you're what she calls a currency user, someone who's using someone else's money, you're paying more attention to cash flows. Where can you get the money from? And if you're a currency issuer, then you're paying more attention to the goods flows. But the constraints are ultimately the same.
Is there an example that you can give of sort of what institution you might be where you start to, the boundary starts to blur a little bit, where you have to worry? You go from being someone who's really myopically focused on the cash flows and getting those to look right, versus someone who starts worrying about larger things, how the macro economy is doing.
Sure. Yeah. So, the transition from the gold standard is the perfect example of this, where the lines get blurred. So in the 1800s, everyone was on a gold standard. In the early 20th century, with World War I, it started to break down. In the 1920s, the United States had so much gold left over from World War I that they really were not up against any kind of constraint that the gold standard was placing on them. And they started focusing more on price stability because they basically had enough gold that, gold reserves could drain for a while before they had to start thinking about anything. So then they started paying more direct attention to the goods flows rather than the gold flows. So that's kind of an in-between type thing. And then the monetary arrangement after World War II, where you had an international gold standard where foreign central banks could claim gold using their US dollars, but then United States citizens couldn't do that. In fact, it was illegal to own gold outside of jewelry and industrial purposes, that kind of thing, in the United States. So there is this transition, and it's important to recognize that ultimately all money is an IOU for goods. So immediately, directly, it's an IOU for whatever's right above it in the hierarchy. So if you're on a gold standard, that's gold. But then the next level up, it's going to be goods. So what happened is that the link between the base money and goods was it had gold as kind of this intermediate step, and that step kind of gradually faded away until it was just directly for goods.
Right. And that makes sense as a transition from one monetary paradigm to another. But can you think of an example to sort of address Stephanie Kelton's point, which is that this is something the government has to worry about, the rest of us can't? Is there something in between, right? Like if you're a really large bank, is there a point where you're not so concerned, where cash flow might be an issue for you? You're a currency user in the Stephanie Kelton sense, but then you're also kind of, if it's a spectrum, right, you would expect to see some actors kind of, it wouldn't be a hard line. You would see some actors be on the way there. Do we see that, or do we not see that in your view?
Well, I would say that since 2008, banks are by and large not cash flow constrained. They've had a ton of reserves. So it's not a matter of like, where do you get the reserves from to cover, deposits being withdrawn or something like that. It's just that the Fed, up until the coronavirus crisis, paid interest on reserves. So then if I'm a bank and I'm getting really good interest on my reserves, I'm not going to create a loan that pays less interest than the reserves, because what if, I create the loan and then people withdraw their deposits, and, then that's a drain of reserves away from me. And I've replaced reserves that paid a higher interest with a loan that pays lower interest. So the constraint starts to look like, well, what's profitable? They're not liquidity constrained anymore. Is that kind of what you're asking about?
Yeah. I was also thinking about trying to untie the association between a government and versus a currency issuer more broadly. And so, you have I think about Perry Marilling's statements about the hybridity of central banks, and how central banks can be thought of as kind of banks that ended up being put in this position to deal with the similar kind of things that Stephanie says that the government should be dealing with, thinking about how the entire financial sector is operating, thinking about the state of the macroeconomy in general. Basically, I'm thinking about how one arrives. If it's true, there's a hierarchy of debt and money. I'm sort of thinking about how one arrives to being up in that position, being the position of what Kelton calls a currency issuer, right? If it's not really just a political thing, if it's not the government, declaring that to be the case, declaring this responsibility for themselves or enforcing it with taxation, then you would expect to see something in the private sector, or something in between the private sector and the government that does this. And I would say the central bank is kind of like that.
Yeah, I think that's right. So the important kind of thing to keep in mind here is that anyone can issue a liability, right? Anyone can make a promise to pay, right? So what happens is that if someone starts using your liabilities as money, if they start just paying each other by passing around stuff that's owed by you, then you're kind of a currency issuer, or you're a money issuer, at least at some level of the hierarchy. So the central bank is the bank that everybody chose to be the money that they use. The issuer, their liabilities are the money that everyone else chose to use. Now, to some extent, the government can put in place, laws and everything that this is our money, blah, 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 blah. But ultimately, the central bank has to be issuing liabilities that work correctly as money, that have price stability and all of that. And you can see this in the Bank of England, how it evolved. It started as a private bank, and then it became kind of the only, or the first publicly owned, like share issuing public bank in England, and that allowed it to grow a lot bigger. And then it became so systemically important that they realized that in order to be profitable, they were the ones who were in the position to make sure that the whole banking sector was functioning correctly. And if it wasn't, they weren't going to be profitable anyway, and that kind of thing. So they became more and more the bank that was the banker for all the other banks, and also the government's bank. And then they kind of became the central bank. But it's all a continuum, as you say. It's if your liabilities are being used as money, then you are a currency issuer at some level of the hierarchy. So let's go to the next one. MMT shows that we don't need to fix the debt. We need to fix our thinking, not just to prevent senseless cuts to programs that support tens of millions of Americans, but also to have a more enlightened debate about the full range of things we could accomplish if we weren't so afraid. The debt isn't the reason we can't have nice things. Our broken thinking is. To fix our broken thinking, we need to overcome more than just an aversion to big numbers with the word debt attached. We need to beat back every destructive myth that hobbles our thinking. And I have to say that spelling error is my spelling error, not her spelling error, unlike the other two. Or her editor's spelling error, I should say. The editor shouldn't have let those slip by. But yeah, so we don't need to fix the debt. We do need to fix our thinking. I'm not sure that MMT has it quite right, because they're not really taking the constraints that everyone's worried about and shifting them and saying, like, these are the constraints. These are the constraints you're worried about, and this is what they look like. They're not where you think they are. It's not in balancing the budget. It's in balancing the flow of goods.
Well, to be fair, I think that they do try to do that, but I don't think you're a big fan of how they try to do that and what they emphasize when discussing those constraints.
Yeah, I don't know that they try to do that. So they try to do something that they see as two separate things, which is to say that the government spending is not financially constrained. And then they separately say that, okay, you might have inflation if the government spends too much or something like that, but they're not linking those two things up the way that I would. They're
saying something important, but they're adding this other thing that you feel, and I'm inclined to agree so far, creates people to misinterpret what they're saying, and causes people to sort of miss this point. because they're not really emphasizing how that ties back to the real resource constraints, and they're not explaining why the current system sort of is set up the way it is with monetary policy.
Yeah, that's exactly right. And then I think we'll get into this later on when we're talking about interest rates, but I think the fact that they are not seeing it this way maybe muddles some of what they think is possible in terms of monetary policy, that kind of thing. Let's go to Bethany has a couple comments. Bethany says they're showing that real resource constraints show up in inflation, which isn't that far, in her opinion, from what I say. She would say that they do emphasize real resource constraints and inflation as what happens when you spend above them. So that's right. I think part of the problem is that inflation can happen at any level of economic output. It can happen at any level of government spending. It's a little more complicated to say. Lining up inflation with real resource constraints isn't exactly right. So it's true that you need price stability and the price stability constraint, but the real resource constraint isn't even the same thing as the price stability constraint. The real resource constraint is you can only buy as many resources as are available to buy. And then the price stability constraint is that the flow of resources has to match the flow of money. And those two things are not exactly the same thing. So let's go to the next one. I don't even think we should be referring to the sale of US Treasuries as borrowing or labeling the securities themselves as the national debt. It just confuses the issue and causes people unnecessary grief. So I think it does confuse some people, but it's because it's not. I would say that it's because they don't really have maybe a proper sense of what debt is as a promise. So I don't know if it would be better to say that U.S. Treasuries, the sale of U.S. Treasuries is not borrowing, because you are making a promise, right? You're making a commitment, and there's a debt that's owed. Each dollar that you hold in your hand is a promise for something. It's a promise for goods. So I think it is I would stick with kind of the conventional nomenclature, but maybe what I would do in the other direction is I would educate people about the different kinds of debt in the economy. Like, people don't even think of, when they have a deposit at the bank, they don't think of that as a debt from the bank to them. They don't think that the bank is borrowing from them, right? But when you have a deposit at the bank, that's exactly what's happened. Exactly what's happening. The bank is borrowing from you. You have money, the bank is borrowing from you. And that's the same thing with the government. If you have the government's money, then the government is borrowing from you and it owes you goods.
I guess it can also be said that most solvent people and most healthy businesses also have like a healthy relationship with debt, right? So maybe I get what you're saying, whereas the answer here is to reframe our relationship with, our understanding of debt, and include money in that understanding. But of course, you could sort of see where the other side's coming from. I mean, Kelton here sounds a lot like Jeff Crocker and the sovereign money community. I mean, they're also sort of saying, well, look, it's money, right? So let's call it money. Let's call it sovereign money, government money. We all know how money works. It's not this other thing that people seem to think it is. I can sort of understand that, but it also, the scale, like the practical things we would have to change in order to accommodate this change in name, nomenclature of removing it as debt. I don't know if that's really worth it, because it does work fine with it as being nominally debt and with us managing it that way. But I sort of get it, because I think at the same time, people are confused about money, right? We don't really get what money is. We don't really understand what function it's serving in the economy. And if we did understand that function, if we understood, okay, well, the economy needs a standard of value, we need something to set prices in, it's a form of debt that we're all using, well, we would just be calling that money, right? So I can see it working either way. And I think whatever side of that historical misunderstanding you're on, and whether it falls one way or the other, that seems almost accidental. I could imagine it have gone some other way. But I don't. Yeah, the nomenclature thing is difficult, because I don't think there's a clear answer on which way is best to describe it. It could work either way.
Yeah, I think maybe there's two questions to answer here. And one is, how do we most effectively communicate to the public who doesn't want to think about the details of how these things work? And then how do we describe it to ourselves, and how do we conceptualize it in our own minds? So in terms of communicating to the public, I have no problem just not using the word debt and emphasizing, oh, the amount of money that the government has issued, right? That's fine with me, but I wouldn't want to go so far as to say, hey, it's not really debt or something like that, because I think that actually serves to confuse the issue as well. Because if you are trying to understand money and banking, and you're understanding, that all bank, as Perry Marilling says, all banking is a swap of IOUs, that kind of thing, you have to understand that these, assets and liabilities are all fundamentally the same kind of thing, and they're issued for different reasons in different circumstances. And sometimes it looks like this is the alchemy of banking, he calls it, two entities are borrowing from each other, and that should mean nothing, but it doesn't mean nothing. Money is being created, that kind of thing. So I think it's important to keep this concept in our heads as we try to understand it at a deeper level, that, oh, this is all debt, these are all liabilities, right? But maybe when talking to the public, we can stop saying national debt all the time.
Yeah, a good reason to not want to just say, oh, forget it, money is not debt, it's this other thing, we just issue it directly, is because that doesn't play nice with a very nuanced and very complete understanding of money as debt from economists who do know what they're talking about. So I can understand why you would cringe at that, because you're imagining Perry Marilling coming along and scolding us not to fear credit.
Yeah, exactly. And Bethany is saying in the chat, I'm not sure how realistic the reframing of debt is for the general public. And I do think there is a real argument to be made that more people are poor due largely to a semantic issue, calling something debt, and then the misunderstandings that follow. I think that's probably right. But again, there's these two issues. How do we communicate to the public, and then how do we understand it ourselves? I tend to be more focused on the latter, but I can see, reasonable arguments for simplifying things for people, not saying things that are inaccurate, but just like not using the word debt to describe our money, that kind of thing.
Money is a debt for goods. I find that very simple, very intuitive, but it is kind of hard to get there from where we are today.
Right. Yeah, it's a claim on goods. You have money, and that means you can buy stuff. And I think that's pretty straightforward to people. The debt thing is harder. Like who owes me these goods, right? What is this? Is the economy owes it to me, or who's making sure of that? Yeah. So let's go to the next one. Like any other holder of US dollars, China has the option to sit on those dollars or use them to buy something else. Uncle Sam doesn't pay interest on the dollars China keeps in its checking account at the Fed, so China usually prefers to move them into what is effectively a savings account at the Fed. It does this by purchasing US treasuries. So this is just emphasizing the fact that China has a lot of dollars. That's money, right? So when we talk about China owning US debt, what we're really talking about is China having a lot of US dollars because we bought a bunch of stuff from them. And that in itself is not necessarily a problem. But as we've been emphasizing in this discussion, dollars are a claim on goods. So if China wanted to spend all of their dollars at once, that would be a drain on goods that we would have to handle, right? So it's not just that that it's a big, nothing burger, as is a phrase Stephanie Kelton uses at some point in this chapter. We're kind of assuming that China isn't just going to want to buy, isn't going to want to turn around and spend all those dollars to buy all of our stuff, because historically they've been continuing to accumulate dollars. If they did decide to do that, maybe it wouldn't be the best idea for them and their economy. But let's assume that's what they decide to do. We'd have to respond in some way, and we can't respond just by printing money, right? These are claims on goods, and we have to make sure that the purchasing power of the dollar is stable. So we might have to respond by taxing, or we might have to respond by raising interest rates if there's still room to tighten monetary policy, right? So it's not, or we might decide that we don't want to do either one of those things, and we decide to default or something like that, which isn't something. We can't really technically default on the dollars that they hold, but we could default on the treasuries that they hold if we wanted to. So there really is, the thing that people are worried about is a real thing. The question is, how likely is it? And I think, China wants to keep selling us stuff and accumulating money, so it's not that big of a deal.
Yeah, ultimately, foreign governments are economic actors, just like everyone else, and they can hold currency, they can spend currency. They're larger holders of currency than other actors, and they can be larger consumers, larger spenders. But ultimately, an institution like the Fed or like a central bank, they're going to have to manage the aggregate spending in the economy. That includes these large actors, but also everyone else, right? Like if you add up all millions of consumers, then into a sort of fictional entity, you could say, oh my God, look at all the money they hold or the bonds they hold or the spending they're doing. It's just one more thing that something like the Federal Reserve will have to respond to when bringing the aggregate rates to where they want it to be.
Yeah. And Bethany says in the chat, perhaps ironically, the idea that China might spend the money back into our economy might be viewed as a positive because it would create a lot of jobs.
Right. If your local government isn't fully employing your economy, then a foreign government could start doing it for you, presumably.
Yeah, right. And right now they're keeping their people employed by selling a bunch of stuff to us. So it would just be kind of the reverse of that. So here's the next one, which kind of continues in this vein. Some people worry that this gives China enormous leverage over the US because China could decide to sell off its holding, driving the price of US government's bonds down and the yield on those bonds, i.e. the interest rate, up. The worry is that Uncle Sam could lose access to affordable financing if China refuses to keep buying up treasuries. And yeah, that's true. If China decided to sell off all of its holdings, it would drive US government bonds down, because we have to remember that the interest rate is whatever interest rate is compatible with stable prices, a stable price level. So if China is selling off all of its holdings, that might increase the yield at which the Fed decides to target in order to keep the price level stable. So there's a sense in which it's not a market rate of interest, but there's the sense in which even the Fed is constrained on what interest rate they can set, because they're constrained by the price level constraint.
I doubt that Kelton's response to a scenario like that would be, okay, the Fed should raise interest rates. How do you think MMT would respond to something like that occurring?
Yeah, so that's one of the weird things about this chapter, is there's kind of this disconnect here. So MMT likes to keep interest rates at zero. That's kind of like their default. The natural rate of interest is zero, is something Warren Mosler and Matt Forstater wrote in a paper. And if you go and read that paper, it's actually a bunch of gibberish and doesn't make any sense. And they don't actually answer the question of why the natural rate of interest should be at zero. And instead they cite a political pamphlet that Warren Mosler wrote earlier than that. So they're like, oh, to understand why, go read this. And then you go read that and it says nothing about it. So that paper is it's the one that MMT people cite most often. And I don't I don't see them really citing anything else, but I could be wrong about that. Anyway, intuitively, you can understand that the interest rate is a price, right? And it's the price of borrowing in the private financial sector. When that price is lower, money is cheaper. There's more borrowing, and interest rates, of course, are the inverse of yields. Are the inverse of they are yields, are their inverse of asset prices. So lower interest rate means higher asset prices. So Stephanie Kelton says you can keep interest rates low. The government can, since they're the currency issuer, they can decide what interest they want to pay. And nominally, that's true. But then you're not keeping interest rates consistent with a stable price level. So she doesn't, at least in this chapter, line up, what she really does admit, which is that there's this inflation constraint. That's not quite how I'd put it, but she admits that, there's this real resource constraint. If you surpass it, you get inflation. But interest rates are also part of that, right? If interest rates are too low, then you get inflation. You violate that real resource constraint, or at least your spending becomes mismatched with your economic output. So I guess your question was, how would MMT say we should respond to this?
Yeah, given that, of course, just like you're saying, they're not such a big fan of raising the interest rates. They understand the problem that it solves, but they don't like that way of doing it. She might get into this in later chapters. So
right. Well, right now she's saying, oh, everybody's worried that it'll drive up the yield on treasuries, but we can control the yield on treasuries. Sure, okay. But if we're keeping the yield on treasuries away from the stable price yield, the stable price level yield, then we have inflation. So she's not mentioning the inflation constraint here. She's not mentioning the price level constraint. She's only saying, oh, well, the yields can be whatever you want them to be. Well, not exactly. That's not exactly right. So let's see. Let's go to the next one here. Oops. There we go. And even if China does decide to hold fewer US Treasuries, yellow dollars in its portfolio, this situation won't leave Uncle Sam strapped for cash. Remember, the US is a currency issuer, which means it can never run out of dollars. So really the issue here is a real constraint, right? They're claiming more goods with their dollars when they decide to hold fewer US Treasuries or decide to spend more money, that kind of thing. And that she's answering that by saying, oh, there's no nominal constraint. So she's kind of dodging the question here. She's saying you might think there's a real resource constraint, but really there's no nominal constraint. It's like, okay, well, you didn't address the question. At least that's kind of how I look at it.
Yeah, I get your frustration with this, but I do kind of want to see how later in the book, if she gets into her model of the problem with conventional interest rate policy. So I sort of want to wait and see how she addresses this later.
Yeah. All right, let's get to the next one here. The average interest rate on 10-year government bonds fell from 3.3% to 1.8% in the United States, and from 5% to 3.6% in the United Kingdom. That's because both countries have a central bank that acts on behalf of the government as a monopoly supplier of the currency. So that's a typo on my part as well. And I should note that she says government bonds, and when she says government bonds, she's referring to all treasuries. She's referring to bills, notes, and bonds. Typically, bonds are used to describe the stuff that's greater than 10 years in maturity. But this is kind of a simplification that you hear with MMT people a lot. They just talk about government bonds as any of the treasury securities that get issued. So the idea here is that, I should give you some context for this quote. She's talking about after the financial crisis, the deficits increased by a lot in the United States and the United Kingdom, but the interest on 10-year government bonds, so the interest on government debt, the interest rate on government debt fell. So that's fine. That's because whatever interest rate is compatible with the stable price level fell. So some people call this the natural rate of interest. So the natural rate of interest in the economy was falling at the same time that the deficit was increasing. That's not necessarily a problem. There's obviously you wouldn't want the interest rates to be any lower than what's compatible with stable prices, and you wouldn't want them to be any higher either. She's contrasting this with the situation in Greece, where the yields went up really high, and they, as they blew past kind of their deficit requirements in the EU, starting in around 2010. And her point here is that this is because Greece is a currency user, and the United States and UK are currency issuers. I don't think that alone is enough of a reason. I think Greece had some constraints imposed on it that were not healthy, that were not necessary. Like maybe they should have been running a much higher deficit, and that should have been fine. And that caused problems. So it's not. I don't think this is a good illustration of the currency user versus currency issuer problem. I think it's, you can certainly imagine a currency issuer that has to pay really high interest on its bonds because it's up to the limit of what its fiscal space is, that kind of thing.
Well, I had a couple points about that, but just to sort of follow up on that. So she's talking about the scenario where Greece, in order to become a member of the EU, right, had to agree to certain rules to not grow its deficit spending, which you're saying could have gotten it out of that. So it can't do that. And it's given up its its national currency to use the euro, right? So those are sort of the two binding problems here. I mean, if you accept those as binding, is there anything they could have done differently to get out of that tangle?
No, I'm agreeing that they had binding constraints on them that were not helpful. And obviously, you can't have those constraints put on you if you are your own currency issuer. You can decide what your constraints are. So in that sense, they couldn't decide what constraints were placed on them. But you could imagine a benevolent EU that doesn't put ridiculous constraints on its constituent countries, and then it wouldn't have that problem, I guess, is kind of the point I was trying to make there.
Yeah, I think you're basically answering in the affirmative yes to the question that Bethany's reposting. Doesn't a currency user like Greece face constraints on spending above the beyond real productive capacity? And yeah, this is I think you agree with Kelton that this is exactly the kind of situation that would cause that. But I guess you just don't find the answer, because we're a monopoly supplier of a currency. You sort of don't find that a satisfying answer. You'd sort of want to ask, like, what are we doing right to remain the monopoly supplier of the currency?
Yeah, and I would say that Greece faces cash flow constraints. Their money is an IOU for euros, right? So their base money is the euro, and they have to think about, well, where can we get the euros from? We face a goods flow constraint. We have to think about where can we get the goods from. So it's ultimately the same thing, just at a different level of the hierarchy. And if you're not managing that hierarchy properly, if you're the EU or the ECB and you're not managing the hierarchy properly, then you can end up placing unnecessary constraints on those below you in the hierarchy. So fundamentally, we're facing the same kinds of things, and you would see high yields for the same kinds of reasons in the United States or in Greece. If whatever the constraints that we're facing, we're kind of coming up against them and we're reaching the limit of our borrowing or the limit of our currency issuance. It's just that Greece is constrained by cash flows and the US is constrained by goods flows. So let's go to the next one here. Congress could do something stupid, like refusing to raise the debt ceiling limit, which might trigger a voluntary default, but there is zero risk of the US being forced into default by its creditors. The federal government can always meet its obligation to turn those yellow dollars back into green dollars. So I'm going to say no, that this is not exactly right. So if the government is at the limit of what it can borrow, even if you're a currency issuer, then you have three options. You can use, as I was saying earlier, you can use fiscal policy to pull away from that limit. Remove some of the claims on goods that are out there in the economy to have less goods claiming going on. You could decide to default on the debt, or you could allow inflation to occur. But the US can be forced by its creditors into having to choose among these three options. Like we were saying with China could force us to have to choose among these three options. So it's not just that you can always turn those yellow dollars back into green dollars. If you view the Fed and the Treasury as a consolidated balance sheet, and maybe they don't care about inflation, in nominal terms, yes, they could always do that. But the way things are set up is that the Fed has no obligation to buy up US Treasury debt, and they are going to buy it at a price that's consistent with a stable price level. So eventually you get to the point where the price of US Treasuries is so low and the yield is so high that the government can't really, the Treasury can't really raise any more money by selling Treasuries, and there's the market is flooded with Treasuries, and there's nothing they can do about it, right? So if you view the two as separate entities, and you view the Fed as having to follow this price level constraint, and that's binding on what the Fed can do, then that again transmits over to what the Treasury can do.
And I think the reason this isn't just nitpicking is because the people who are on the other side of this argument, they're not confused about this. They're not confused about the government's technical ability to turn yellow dollars into green dollars or to print money. They get that. What they don't like is the risks to inflation and all these other problems. So I get why you keep harping on this point, even though I know that MMTers will feel that you're missing the point.
Yeah, I mean, I think everybody, economists at least, understand what it means to monetize the government debt, to turn the yellow dollars into green dollars. They just know that there's a limit to how much of that you can do. And if you try to push past that limit, then that causes other problems. And I think it's just important to remember that the creditors of the US are the people who hold its money, whether that's China or just ordinary people. If everybody panics and starts spending their dollars, that's the same as China trying to spend all its dollars, right? So they can force anything like that, can force the US into a difficult situation, and push them up against their real capacity constraints, because by spending their dollars, they're claiming more goods.
I like that. If you hold US dollars, you are a creditor, essentially, of the US government.
Yep, they're borrowing from you. And they're, the fact that they're borrowing from you is actually a benefit to you because they're making this promise to you and they're not asking for anything in exchange for this promise necessarily. So in that sense, it's like I borrowed a bicycle from you, but you never gave me a bicycle to begin with. I'm just promising to give you a bicycle at some point in the future, right? So that's good for you that you're borrowing, or that I'm borrowing from you, because you never had to give me anything in the first place. Let's go to the next one. MMT flips this around, showing that the more appropriate real-world sequencing is STAB. So that's spending before taxing and borrowing. The government spends first, makes dollars available to pay taxes or purchase government bonds. So the reason that Stephanie Kelton tries to kind of flip the order of this and saying that, oh, well, the government spends the money first and only then taxes or borrows, is that she wants to emphasize that the government can kind of just spend whatever it wants. But in the real world, especially if you're looking at the Treasury by itself, they are constrained by how much tax revenue they get, and they are constrained by how much borrowing they do. The question is, can they borrow forever? And the answer is, well, yes, if the Fed is willing to buy up infinite amounts of treasuries. And the answer is no, if the Fed is not willing to do that, if the Fed is actually committed to keeping the price level stable.
I'm not sure it was this quote, but it was a quote very much like this in the chapter that talks about how the government spends this money into existence, and then that's the money that can be used to buy the bonds and that sort of thing. But I think it's also worth pointing out, right, that the government's not the only currency issuer here, and a lot of government bonds presumably are bought with dollars that were not specifically issued by the U.S. government. It's not like it has to issue them first so that the taxes and the bonds can be purchased.
Yeah, so most of us, when we buy government bonds or when we pay taxes, even what we do is we're spending our bank account balances, right? And that's not government issued money. But it's important to realize that when deposits get transferred from one bank to another, there's also a transfer of reserves, which is government issued money. So even if you're paying your taxes or if I'm buying a government bond from you, there has to be no movement of government issued money, especially if we're at the same bank. It's just a transfer of deposits. But if we are buying them from the government, or if we're paying our taxes, that is a transfer of reserves of base money back to the government. It has to be. Yeah. So in terms of the taxing, I just want to emphasize again that we can think of taxation as by default an obligation to pay goods or resources to the government. And by paying them these IOUs for goods and resources that they issued, that stands in for the goods and resources themselves. So it's still, the government taking something that's out there. It's not just taking something that it issued, although it issued claims on the things that were out there. Essentially, it's taking back some of its promises. It's like you can satisfy your tax obligation by saying that we don't have to promise you these goods anymore, right?
I'm not sure I quite follow that, but we also don't have too much time left to untangle that particular thread. Are there any other important quotes that you want to get to? I don't want to.
Oh wow, I lost track of the time there.
No problem.
Yeah, let me find one final quote to do. Yeah, so we're gonna do this one. Yeah, my where are we? Here we go. Yeah, I got so into the discussion that I completely lost track of time. So this is going to be our last one. Every dollar that is paid in the form of interest becomes income to the bondholders. If those interest payments become too large, the result is that total spending could push the economy above its speed limit. MMT has emphasized that rising interest can serve as a potential form of fiscal stimulus. So this is something that I see with MMT a lot, and I brought it up earlier, that when they think about interest rates, they're thinking about the interest payments. So they're thinking about the cash flows that the interest payments constitute. They're not thinking about the interest rates, or they're not as much thinking about the interest rates as a price. So interest rates are a price of credit. And if the price is higher, that means there's less credit creation in the private financial sector. Normally, that is the larger effect. The price effect is the larger effect, not the cash flow of the interest payments themselves. That's negligible, right? Now, if you could imagine kind of a degenerate scenario where interest rates are kind of off the charts high, then you don't really have borrowing in the private financial sector anymore, because anytime anyone wants to save, they just lend to the government and get really high interest payments anymore. So you've eliminated the private financial sector, and then you start to run into problems, and you might have some inflationary effects. At that point, it wouldn't really be from the interest payments. It would be from the fact that nobody's investing in businesses anymore, and everybody's just lending to the government as their savings instead of into the private sector. And you can imagine all kinds of problems. But in the normal world, how we operate, higher interest rates mean less money for bondholders, especially since the prices of those assets are going to go way down, and people can't really borrow to buy these assets anymore either. So you'd see like a crash in housing prices. Pretty much most prices across the board would go down with higher interest rates, and that's just generally kind of how it works, and that's the standard thinking. And this is something that I think MMT gets backwards. Interest rates are prices. If the price of borrowing is high, then there will be less borrowing and a general contraction in activity in the private financial sector.
But the reason why you feel that way, right, is because as to what MMT is saying is thinking of currency as base money. It's thinking of money is coming from the government. So it's high-powered money, it's special money, and so they're thinking of that base money entering the economy as a kind of fiscal stimulus. But what you're saying makes more sense if you're thinking about actually most of the currency issuers being in the private sector, most of our money coming from there, and therefore a stimulus for cheaper borrowing, for more incentivized borrowing in the private sector and money creation in the private sector, that's obviously going to outweigh what this one particular currency issuer is doing, the government.
Yeah, this is essentially a subsidy for paying people not to lend. So there's all kinds of different taxes you could have. Some of them might be inflationary, some of them might be deflationary. There's all different kinds of subsidies you could have. Some of them might be inflationary, some of them might be deflationary. And it all depends on where you're adding the money to in the economy, for what purpose, what are you paying people to do, where are you taxing the money away from, what are you punishing, that kind of thing. The cash flows are important too, but they're not the whole story. And with interest, they're not even close to being the main story. So that's just something to keep in mind with interest rates. All right, so we are at the end of this discussion. There's a lot I didn't get to, but I think we covered most of the important points. Next week, we are going on to chapter 4, which is Their Red Ink is Our Black Ink. Thanks, guys.
Looking forward to it.